Do the prices match up? Does the timeline match up? All these things to make sure that we're actually checking a lot of boxes for our passive investors, right? We're trying to protect them by doing all the hard work and asking all the hard questions up front that they may necessarily not have the time or the know-how to do for themselves, right? And then we talk to them about their investor communications. What's your cadence? What do you include in your reports? Here's what we expect. Can you send us some previous reports? All stuff like that, so that when we do onboard them, we know that we have done our part for looking at them.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Tim Lyons. Tim is the co-founder and managing partner of Cityside Capital, along with his brother, Greg. He is a registered representative of Phase 1 Financial Services, a broker-dealer based in New York City. Tim holds the Series 82 and 63 licenses and is focused on raising capital for multifamily, self-storage, and industrial assets that provide great risk-adjusted returns, tax advantages, passive income, and equity upside. Tim is also an 18-year veteran of the New York City Fire Department and currently serves as a lieutenant in the borough of Queens. Tim, welcome to the show.
Tim, thank you so much for having me as a guest here. I'm happy to be here.
Yeah, and it is great to have you. First of all, thank you for your service as a first responder. I know you guys don't always get the shout outs like we in the military do, so I wanted to make sure that I extended that right up front. I gave everyone a high-level overview of your background, but on this show, we really like to get into the details on how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
I will do, Tim. But first, I just wanted to jump in. I wanted to thank you and your brothers and sisters for their service because, as you can see in the background, I am a patriot. I love this country, and I really love and support all of our military members and former members, and I have family members who have done the same. Thank you, my brother.
All right, thanks.
All right. How did I get started? Man, I was a firefighter and an ER nurse, right? And because a lot of firefighters, we work 24-hour shifts, and a lot of guys have second careers, right? A lot of guys do handyman work like plumbing, HVAC, roofing, siding, windows, construction. And I happen to be allergic to a hammer. I didn't grow up knowing how to use tools, even though I'm a firefighter. I should probably know how to use a couple of them. And I do. But when it comes time to doing the construction stuff, that just wasn't for me. So I bounced around. I did some risk management, kind of corporate level jobs as like a per diem with an insurance company. That was cool, but not long term. And finally, I started working with, I worked with a whole bunch of nurses, and there was maybe 4 of them in my firehouse, and they had nice cars, and the wives stayed home, and they always had work, and they were happy. And I said, you know what? I was pre-med, Tim, in college for about 15 minutes. I had an interest. I was an EMT in college. I said, so why not go to nursing school? That's what I did. And whatever, got a job in a hospital. I worked in neurosurgery. I worked briefly in orthopedics, and then I worked in the emergency room, and I found my passion. I went from the 24 hours in the firehouse to 12 hours at a time in a level 1 trauma center, and I was fulfilled, right? I had 2 great jobs. I had work when I wanted it. And I just come from the scarcity money mindset, Tim. I didn't grow up with money. My parents were divorced when I was 3. If we talked about money, Tim, it wasn't a good opportunity to talk about. It wasn't a good conversation about money, put it that way. So to me, getting paid every 2 weeks was the way. Putting money into my 457 and my 403B, that was the way. Getting a pension after 20 years of service, that was the way too. Buying a house, trying to pay it off as quickly as possible, don't taking on debt. This is probably sounding familiar, right, to a lot of the people out there. But what I started to notice is that working 2 jobs, 80, 90, sometimes 100-hour weeks, and in the meantime, my wife and I had 3 little girls who are now 12, 9, and 4. That wasn't conducive to family life, to being a good husband, to being a good father, to enjoying the fruits of my labor, right? So I went down this personal growth and development and path, and it came down to one word, Tim, and that was equity. Actually, 2 words, equity and cash flow. I thought I had cash flow from my W-2 jobs, but I realized that there's something called passive income or passive cash flow, and I needed that, and equity. And the 2 ways I distilled to get equity, Tim, was through real estate, number 1, or starting my own business. And I felt like starting my own business wasn't going to be what I was looking for. I was looking to save hours, not really contribute a whole lot more and risk. And I don't know what I'm doing and failing forward. And it wasn't like I had endless funds to lose in a business endeavor. So real estate became the way. Around the same time, there's a book right over your right shoulder called Rich Dad Poor Dad by Robert Kiyosaki. Many of the listeners probably heard of it. I read that in 2 days on a family vacation in July of 19. I couldn't put it down. I had a beer in one hand. I had the book in the other. Then I was building sandcastles for about 10 minutes. I went right back to the book. I couldn't get rid of it. And it changed my life. I know that sounds like a pretty big statement, but money. It reframed investing and what it means, assets and liabilities. And you know what, Tim? 2 months later, I'm sorry, 4 months later was November of 19. I bought my first three-family property. It was an hour and a half away from my home because in New York City and the greater New York City area, it can be hard to cash flow. I'm happy to jump into that first one, but that was really the pathway that I had to get to into real estate.
Yeah, and so there's a lot to unpack there, and I'm seeing and hearing a lot of similarities with my own journey. Sounds like you were born in New York and probably stayed there for for pretty much your whole life based on your accent. I was born in Jersey and lived between there and Connecticut because, like you, my parents got divorced when I was like 2. So back and forth between the two. Divorce is never good for finances. First of all, spoiler alert. Yeah, face a lot of those same money challenges and just the mindset, right? My dad was a TV repairman. And so all he wanted for me was, please just go to college, get a better job than I have, that whole piece. And so I'm glad you were able to escape that scarcity mindset, but it takes a long time, right? It takes exposure to different things, different ways of thinking. And then you're like, oh, okay, so not all things are possible. Once you shift your mindset, then you can focus on different things and really accomplish different things.
Yeah.
And going on to some of the other things that you talked about, one, don't have any shame about not being a handyman. I'm not either. I could change my own car battery. That was my big accomplishment for this past weekend. So I earned my man card as far as I'm concerned. But otherwise, a lot of times I'll pay for the service, right? It's not worth my time, especially when I screw it up and it'll take twice as long to fix. Going into how you got into real estate itself and Rich Dad Poor Dad, that's not an unusual story, right? Because it makes this paradigm shift with a lot of people. They're like, oh, I've been doing this wrong, right? Or I've been thinking about it wrong. And just like you, that's when I feel like I first understood assets versus liabilities and decided I needed to do something about it because I didn't have enough of those assets things that I certainly should. And you talked about entrepreneurism and starting a new business. And I think you highlight an important point about the risk associated with that, right? Not to dissuade anyone from starting their own business, but there's a huge amount of risk. And depending on what type of business it is, huge amount of capital up front as well, that if things go wrong, that capital is gone. Whereas with investments, that's usually not the case. Can you invest in a stock that goes to zero? Sure. Can you invest in a crypto that goes to zero? Sure. But with real estate, that is very rarely the case. Talk to me about that first deal. Did you have to put 25% down on it because it was an investment property? And was that a single family home or was that a small multi? Talk a little bit more about that.
Yeah, so it was a small multi. It was a three family house. It ended up being in New Haven, Connecticut, in an area called Westville, and we bought it for 276. And when I say we, it's me and a partner because when I talk about scarcity mindset, I really mean what I say. I didn't want to do it by myself. I was nervous. I was scared. I just wanted a partner there with me. I wanted a three family or a duplex or a quad because that was able to qualify for traditional financing, 30-year fixed mortgages. I wanted more than one unit because I felt like if one or two units were vacant, I could still have some kind of cash flow coming in. So for all those reasons, that's why we settled on the triplex. And it turned out that we needed two units to pay for everything. And that third unit was really the cash flow. We bought it for 276. The taxes were about 6,000. And by the time, this is November of 19, we were nervous about buying it in our own names, right? It was a friend of mine. It wasn't like me and my wife or anything like that. So it was a friend of mine. So I said, why don't we do an LLC? And you learn a lot by doing this, right? It's a lot of experiential learning. We didn't need an LLC, really. I mean, you go on Bigger Pockets or you just Google, do I need an LLC to buy real estate? Like you're going to find a billion articles going both ways.
Right.
But we ended up doing that. So we set up an LLC, and then it turns out that you can't qualify for traditional 30-year fixed mortgage rates because you're into the commercial realm because you're investing through a business entity. So anyway, we ended up getting a 10-year note with a 20-year amortization at 4.5% at the time, which was like a full 100 basis points more than regular mortgages were going for. And we put 25% down. With the 25% down, we split everything 50-50. And then we put a new roof where we paid to have a new roof put on and a new siding. And then Craig and I, my partner, we actually broke out the tools and we renovated the first floor unit. We painted, we replaced cabinetry hardware, we fixed the little holes in the wall. We actually went out of our comfort zone and put the LVP flooring in, the life proof LVP flooring in 2 of the bedrooms. It took us about a month probably, which is a really long time to do to get a turn going. We did it and we started cash flowing right then and there. And we did a little better on our taxes. We had some cash flow coming in. We have proof of concept. But what I realized was that I hated being a landlord, right? It was a 3-hour round trip. It was phone calls nonstop. I had 3 single moms with kids in the units, and they needed help with light bulbs, and the windows are buzzing, or there's a draft coming in my living room window. And we got a call one night. There was 2 bats in the back stairwell. Can you come get them out? And I'm like, oh my God, 3 hours round trip to get some bats out of the real estate. And I didn't want to, I was cheap, right? So I didn't want to pay for a third party property manager, but I also wanted the experience. I wanted to know if I liked it or not. And while I was addicted to the tax benefits and the cash flow and having real estate pay me in 5 ways, I really wanted to get into it more. I just didn't want to be the guy to be the landlord anymore.
Yeah. And I think so many people discover that after they've done it. I was no different. Mine just took a little longer because I did do that third party property management on my first property, which was just a duplex. But that's because it was like 3 hours away. So it was not feasible, right, to be my own property manager. So I sucked up that 10% that the property manager was taking off the top. And ultimately, I don't know how much it was worth it from a cash flow perspective because they were taking their 10% and you have one eviction or something big break down and you could wipe out a year's worth of profit cash flow wise. Now, in terms of value, the value of the property went up enough that it still made it a good deal for me in the long run. People need to think about that stuff. And then on my second property, I ran into the same thing that you did because when I started going down the bigger pockets rabbit hole, I was like, all right, I'm going to do everything like I'm a business. Let me get my LLC. And I focused for weeks on the name and the logo and all this stuff that does not matter because it's going to be a pass-through entity anyways. And then that's when I also found out that I was getting a commercial loan. And I was like, this isn't a commercial property. This is only 3 units when I moved up to my triplex. He was like, yeah, but it's an LLC. And I was like, but no, these rates are higher. I don't want this. This is what it is. And I think this little things like that you just learn because no one tells you. I don't know. I feel like it's not one of those things that I read in a book. Maybe it is somewhere, but I felt stupid afterwards, but I was like, shit, no, we're already here right at the table now. Right. So might as well just go through. And so on that property, it was 20 minutes away. So I was like, yeah, I'm going to save that 10% on a property manager. And so it's not about just being a landlord because you are the property manager at that point, which is a whole nother level of involvement. And even though I'd try to play it off whenever I went over to the property to fix things and be like, oh, I'm just the property manager, they knew I was the landlord. And they're like, yeah, we know you own the house. And like you said, just stuff comes up all the time, especially if you're at different tiers of renters. Like some are just require more than others. And mine were fit into that mold. So I had a couple get arrested. I had a bee infestation in the bedroom. And I'm like, what? I can't make this stuff up. Like they just call me up and say there's bees flying around in their living room. And bees had literally in the windowsill had made a nest. And so then I had to call like a beekeeper out to cut out the entire portion. And of course, my tenant's biggest concern was the safety of the bees. They wanted to make sure that it got done humanely. And I was like, you can't sleep in your bedroom that probably shouldn't be your largest concern. But anyway, whole point being, like, stuff like this comes up all the time at all hours. And I was working full time as well. And so it was sucking up all my weekends. And so you go to that time, cost, benefit analysis. Is this worth it? Is this
Mhm.
additional time that I'm spending both after work and on weekends really worth that 10% that I would be paying to a property manager? And is there a better way? And so that's where I found myself. And it sounds like you found yourself in a similar situation.
100%. And to be clear, I think there's a great book called Millionaire Fastlane by MJ DeMarco. And
Mhm.
he talks about there's a lot of hard yards that have to be put in before you can enjoy the fruits of your labor. Like about if you want to have a portfolio of 10 properties or you want to hit your monthly cash flow number. But people want that immediately and then they want to go on easy street. And there's really no big event, Tim, right? Like you just did a beautiful job about laying out the B's and the issues that can come up and renter problems. And there's a lot of hard yards that have to be put in before we can have some of these benefits, right? So when you do have to do the time versus cost analysis, that has to factor into it, right? This is a process. This is a journey. You're going to stack wins on top of wins, and hopefully you can compress timeframes by listening to podcasts like this or joining a mentorship or going to meetups. There's so many ways to compress those timeframes, which is what I did, so that you can start to take back your life and own your time and do some of those things. So I love the way you frame that.
Yeah. And I think a lot of it comes down to knowing what your own priorities are. If you're a single guy, you're in college, whatever, maybe you got all the time in the world to go over and handle things like that. And maybe your time, that time isn't as valuable to you as someone, say, who has three daughters and wants to make the most of that very short time that they have with those daughters while my kids still think I'm cool. That's the time that I want to prioritize. And we're still there. My daughters, I'm a girl dad too. Mine are only 5 and 8, and I want to spend as much time with them while they think I'm still cool as I possibly can. And I have to take that into consideration in terms of my priorities. So that's inevitably going to make my time more valuable than, say,
Very
someone
much.
who has a whole lot of time on their hands, right?
Yeah, and I had a coach just maybe 2 years ago point out to me, "What's the value of your time, Tim?" And at the time, I was like, "I don't know. I make $50 an hour as a nurse. I don't know, 55, 60." And he's try 300 or 500 or even 1,000. And I was like, "What do you mean?" And when he took me through this exercise, I was blown away, right? Like I see your book behind you, Who Not How, right? Asking who can do this better than I can in a more squared away fashion, and I can probably pay for it, and it'd be awesome. And then I can go do my high value tasks of with investors, touring properties, raising capital for deals. Those are the equity and revenue drivers of my business. So should I be cutting down podcasts and making reels, or should I be talking to investors? But also the value at home. We only get 18 years technically before our kids, A, don't think we're cool, Tim, and B, maybe leaving the nest. And like you, I want to maximize that time. And to me, that time is invaluable. And there's a struggle, right? As a investor, as a human being, as a dad, like how much time can I and should I be spending with these folks and how do I make that happen? And honestly, that's really was my part of my motivation to do what I'm doing today was I needed to make a change. I was getting crushed in my W-2. I was losing hours, tired after coming home from a 24 or even a 12-hour shift at the hospital. I'd get home at night and I was crushed. And the last thing I wanted to do was get on my hands and knees and start playing Barbies or whatever the case might be. And to me, Tim, that was not living, which is really when you read any 101 real estate book, they'll talk about your why, your quote unquote why you want to do this, and then they'll take you to step 2, which is your goals. So I just saved you a couple of hours reading some 101 books about real estate. So once you have that down, that's why we're here today.
Yeah. And I think that's something that a lot of folks who are getting into real estate and they're trying to scale and build, like if they do still have that scarcity mindset to your earlier point, that's where they can run into that brick wall because they're like, oh, that's a lot of money to spend on coaching, or that's a lot of money to spend on that virtual assistant to do this work for them. And if you can't, even though you could write down on paper and recognize the fact that you need those folks to be doing those things so that you could focus on those $1,000 an hour tasks, it's a little bit harder if you still have that scarcity mindset to break through that and just throw the money down. But once you do, then you start to see the value and you're like, oh man, that just saved me this much time. Now I can focus that time on this, like you said, getting investors, having those phone calls, meeting with potential partners, whatever the case may be, those things that only you can do that your virtual assistant can't.
That's exactly it. And that's part and parcel why we've been able to scale the way we have.
Yeah, and we're going to get into that. But first, I wanted to clear up some stuff that we talked about at the front of the show in your bio. We used a lot of fancy terms. So, for the sake of the listeners, can you please explain what a registered representative is? And then we can get into the licenses, the Series 65 and so forth.
Cool. Yes, when people run out of their own money to buy real estate, they tend to learn how to read a book like Raising Capital for Real Estate is on Tim's top shelf there. To raise money from friends and family at first, and then beyond friends and family, strangers, and how to talk to them and how to raise capital and do bigger deals and support them in their investing journey. But there's a lot of rules and regulations that happen to surround how to raise capital properly and legally and without fraud. And when I basically learned about that, I realized that there's really two ways for me personally to raise capital. And that was to do my own deals and with my brother Greg, who is my partner. But I was in New York, he's in Virginia, and we wanted to invest in Texas and Florida and the Carolinas and Georgia and Tennessee and Arizona, and we weren't going to be moving there. The next best thing was to cultivate our ecosystem and teach them about what we're doing. But we had to be licensed to do that because you can't raise money for other people and just get paid based upon how much money you bring to the deal. That's securities fraud, and you can go to jail. And we didn't want to do that, right? So that's the reason why we became what's called a registered representative of a broker dealer. And a broker dealer is nothing more than a company that buys and sells securities on behalf of themselves or their investors, right? So broker dealers could be like Fidelity or Vanguard or Goldman Sachs or JP Morgan Chase. They sell stocks and bonds and ETFs and futures and puts and calls, whatever. Those are broker dealers, but they do it on the equities and the like Wall Street side of the equation. We are working with a broker dealer that only does what's called a private placement investment, which is in commercial real estate for us. So my broker dealer only focuses on multifamily, self storage assets, and industrial triple net lease assets across the United States.
Okay. And so I think that helps. And just to give people like a counter to that in terms of as it relates to what, right? Myself, for example, I'm a sponsor, syndicator, whatever operator, whatever word you want to use, right?
Yep.
Yep. And so we buy the deals and we operate them. We also raise capital for it, but we have a material role in the deal, right? We're in it for the long haul. We're going to the meetings with the property managers. We're making legal and business decisions associated with that deal. What you're talking about is exclusively raising money for those same deals, but not having like material participation in it or decision making. Is that right?
Those are the key words: material participation, right? If you have materially participated in the running of that asset. So let's break it down in an example. Say,
Mm-hmm.
Tim, you come to me and you say, Tim, I have a 100 unit in Florida and I would like you to raise capital for me. I heard you can raise money and I want to pay you to raise capital. Cool. I couldn't bring Tim $10 million and say, you know what, there's a formula here. Why don't you give me 5% of the capital I bring to you? And then I want 10% on the back end. And then I never go to an asset management call. I never tour the property. I don't do due diligence. I don't have any votes in what color paint we're going to do or the granite countertops that we're going to buy or the three bids on the roof materials that we need to do. I don't have anything to do with it. I just move on to the next deal. That's considered securities fraud. And both Tim and I would be liable. Him for paying me and me for being involved by bringing capital and raising money the wrong way. Now, as a broker dealer, I can do that same deal, right? If we do our due diligence on Tim and Zana Investments and we onboard them onto our platform and we have an agreed upon contract and we say, oh, you have a deal, let us do our due diligence on the deal. And if we feel strongly with, just like you do, then yes, we will raise $10 million and here are the terms. Because we have our licenses and we work with a broker dealer, that's all above board. That's how we make our money. That's how you get your equity. That's how we serve our investors and everything's good. I hope that helps.
No, it does. And because we've had like fund managers on the show before, can you talk about maybe the differences between a fund and what you're doing?
Cool. So anybody can start a fund of funds, right? I'm sure
Hmm.
people have heard that, a fund of funds or an SPV, which is the term, it's called a special purpose vehicle. So to do that, say you had the capacity to raise $20 million from your friends, family, coworkers, your ecosystem, right? You could set up a Reg D, 506B or 506C fund, or even a Reg A offering up to 20 million, and you could now raise 20 million, and you can go to operators like Tim or other operators out there and say, look, I know you're offering a 7% pref and an 80/20 split to your investors. If I'm able to work with you and bring capital to your deal in one big check, not 100 or three, $50,000 investments, I'm going to bring one check to your deal, but instead of a 7% pref, we would like to negotiate an 8% pref for our investors.
Hmm.
And instead of you offering 80/20 to my investors, I'd like you to offer 75/25 or even 70/30. And now, as a fund of fund manager, you would have an accounting firm keeping track of all this. And you could charge the fund, if you're in charge of the fund, you can charge the fund an asset management fee, a disposition fee, a acquisition fee, right? So you can make your money by running the fund, or you could also keep that instead of a 7% pref like you were offering, and now we negotiate an 8, you could keep that 1% delta instead of an 80/20 split that you were offering and we negotiated a 70/30. There's a 10-point difference there. Maybe you could keep some of that for yourself as well. So that's how a fund of funds works. It's totally legal. It's how people make money. It's how Wall Street does it. It's how private equity firms do it. I don't know if you ever heard of the term 2 and 20, right? 2% yearly fee for being involved in with a private equity fund, and then a 20% take on the back end, right? So there's all these ways of structuring a fund of funds, and they're legal, and they are definitely a way that a lot of people raise capital and serve their investors to get into bigger deals.
Yeah, and I guess, is there any advantage or disadvantage between starting a fund versus someone going out and getting their licenses so that they can do what you do?
Yes. So if you have the capacity, the ability to raise, I would say at least $10 million, and people are okay, maybe not getting a distribution right away. They will know, like, and trust you. They understand the model. They understand the asset classes, the whole thing. Yeah, you can easily raise 10 million and then start to negotiate during that period while you're simultaneously raising capital. You're also talking with the operators. Hopefully, you already have them in your stable, ready to go, but negotiating those terms, right? So you can go to the operators and say, look, I can bring you X amount of money, $1 million a deal, whatever. But these are the terms that I would like to have my investors have, right? So as long as you can match those two things up and it's profitable for you, then yes, I would say do that. If you're just starting out raising capital, I don't know that I'd raise a fund of funds, right? Because it's going to cost you probably 20 grand to get started between the law firm that needs to set up your PPM and subscription documents.
Mhm.
Your portal is probably going to be four to $10,000, depending on what portal you have. Then you're going to have another $10,000 a year, probably, or more, for an accounting firm to audit your stuff and to send out K1s at the end of the year. So there's going to be significant upfront costs, right? And you can wrap that into the fund's asset management fee, but there are significant costs to get set up correctly. So if you can't raise and you don't have that firepower in the beginning, and also if you don't have the operators that you already have an agreement with, that's going to be really hard, and that might set you back quite a bit.
Yeah, no, I think that's some good insight on just I don't want to say challenges, but considerations between
Considerations.
the two different routes. So say I'm someone who's thinking about investing and I know you, I think you're a stand-up guy. Talk to me about how you explain the services that you provide, as part of your, I'll just call it due diligence on deals and sponsors and everything else.
Yeah, so we have to abide by a SEC rule called suitability, right? So we need to make sure that our operators, we call them issuers, right? If you are issuing stock in a company, you're the issuer. But the operators, the people who run the multifamily or self storage deals that we work with, they're called operators, syndicators, issuers, all synonymous terms. We got to make sure that we do our due diligence to make sure they're a suitable issuer for our platform. So we look at their track record, their history. We look at their deals. We walk their deals. We talk to their property management companies. We'll talk to the on site staff. We also have a third party due diligence firm called CrowdCheck that'll look at their LLC formation. Are they set up and are they in good standing? Did they own the properties that they said they owned in their glossy, sexy deal deck that they send out to everybody with the palm trees and the pools and the weight room and everything that we see? Did they own those deals? Did they sell them? Did the prices match up? Did the timeline match up? All these things to make sure that we're actually checking a lot of boxes for our passive investors, right? We're trying to protect them by doing all the hard work and asking all the hard questions up front that they may necessarily not have the time or the know-how to do for themselves, right? And then we talk to them about their investor communications. What's your cadence? What do you include in your reports? Here's what we expect. Can you send us some previous reports? All stuff like that so that when we do onboard them, we know that we have done our part for looking at them. Are they a good operator? Do they talk to investors on a timely cadence and with substantive reports? And are they open to calls and webinars and all stuff like that? And obviously, we haven't even gotten to what asset class are they in? What market are they in? Do we want to be in that market? Why do they like that market? Why do we like that market? All stuff like that. So then when we do bring them on, now they're onboarded and they're ready to go, right? So now when they bring a deal to us, they say, hey, we have a deal under contract. Here is the most updated rent roll. Here is the last 12 months of the P&L statements. And here is our underwriting for the deal, why we think it's going to be a great deal, why it works, right? And then we have an in-house underwriting team that will go to work looking at their assumptions and looking at their deal, right? Is their underwriting tight? Is it within industry standards? Are they forecast like during COVID, when say Phoenix is getting 20% annual rent bumps, are they underwriting 20% annual rent bumps or are we down to 2 or 3%? Maybe even 0% year one. We love to see that. We have a series of checks and balances so that when we decide to do a deal, we know that we've checked a lot of those boxes beforehand before we go out to our investors and try to raise money. On the flip side, Tim, we also do the same thing for suitability for investors. We need to make sure that they're, as a limited partner or a passive investor, are you accredited or non-accredited? If you're accredited, there's basically three, sometimes five boxes to check, right? It's either income for you personally, income for you and your spouse, net worth requirement, or there's some licenses that you can have, or there's also an entity structure that you can have to qualify for a accredited investor. If you're not accredited, we got to talk about a couple of things like what's your current financial situation? What have you invested in? Do you understand the asset class? Do you need extra help figuring some of that stuff out? We do all that in the background. And the benefit for the operators is, look, you could always use more money and they can all raise millions of dollars by themselves. But if they're doing velocity of deals, or maybe their strong point is running deals and acquisition, and it's not so much investor relations. So like that's where we can support an operator on the other side.
Yeah, that's interesting. I would have just assumed that only accredited investors would be able to invest with you. But from what you're saying, that's not the case. But it sounds like that and I'll use air quotes, sophisticated investors is the word that the SEC uses, can also invest with you, but you have to follow the same guidelines that say I would have to follow, which is that, let's call it a substantive relationship, having known them a certain time, understand their financial situation, etc.
That's why we have leads and funnels and social media and talking on stages and going to meetups, because to tell people what we do and then to develop relationships going forward. But yes, we do actually, we do a majority of 506B deals. And the reason is that you can have an unlimited amount of accredited investors and up to 35 non-accredited folks. But those non-accredited folks, those spots go really quick, right? They just go really quick. They're sought after. There's a limited number of them. But there's just a lot of a step or two less friction when raising capital than doing a 50C deal with accredited investors only. And for example, one of them is having them sign and have signed a accredited investor form. That has to be signed by their CPA or their financial advisor or their attorney. Sometimes they have to be notarized. There's just like a lot of steps that can cause friction when raising capital, which is why we just like to do the 506B deals. But we do both.
Nice. Okay. You were talking about different types of assets. Talk to me about what types of assets you guys primarily invest in. And just moving forward, let's look into our crystal balls the next 2 to 5 years. Do you think that's going to change? Are you shifting towards other assets over the course of the next few years?
So right now we've done 25 deals, and majority of them are multifamily across the Sun Belt and Midwest.
Mm-hmm.
And we believe in the investing thesis behind multifamily. We think people need food, clothing, and a place to live. It turns out people like to go to bed at night with a roof over their head, and they like to be in safe, clean, affordable housing. So we believe in that. We believe that there's a structural deficit of affordable housing. And when I say affordable, I don't mean like strictly Section 8. I'm talking middle class folks that are just looking for a 2 or 3 bedroom apartment with laundry in there, and that's clean, safe, affordable. And affordable is key, right? Because it's just not out there. When builders are building today, they're building Class A product with the sexy pools, palm trees, and the state of the art gyms. And people that we're looking to serve are probably in well below that. That's why we believe in multifamily. We're not going to stop as far as I know. So that's one asset class that we really. Number two is self storage. Self storage is getting beaten up in the press lately because we're heading into a recession and people are clamping down on their pocketbooks. And I think also the biggest thing is that people thought self storage was sexy in the last 5 or 7 years and they started building it like crazy. So some markets are getting beat up a little bit because there's an oversupply. But it turns out that as a consumption society, we like to buy a ton of stuff and we never like to get rid of it. We don't want to get rid of mom's or grandma's heirlooms and we don't want it in our basements. We put it in a storage and we get hit for, I don't know, $49 a month. And it's on a debit card. We don't notice it and it just cruises along. And you know what? Honestly, with systems and processes, we can only have maybe one full-time person on it. And we can hit them on the debit card and there's no cash being changed. And if somebody doesn't pay their rent and they get evicted, you know what? We pay somebody to go in there, cut the lock, donate everything, and then broom sweep it, put a new lock on. And now we have another open unit to rent out. So we really like self-storage, especially in the Southeast where there's boat storage opportunity, climate controlled opportunity, because 75% of the self-storage assets in America are owned by mom and pops with not a lot of systems sometimes. They haven't raised the rents in 10 years. But they're also getting tired and they want an exit plan. We look for our strategy as a value add strategy where we can find a mom and pop, we can implement systems and processes, but there's also a big enough footprint on the property to add maybe 10 or 20,000 square feet of new boxes, maybe some boat storage, RV storage, depending on where we are, and some climate controlled stuff. And that could be our value add. So we like self storage for those reasons. And thirdly, industrial triple net lease, which is the newer asset class for Cityside Capital. It's a cash flow play because a lot of the deals that we're doing, I'm sure you heard of just in time at the Amazon way of just in time shipping, but there's been a incredible push to reshore or onshore some of our supply chains and manufacturing lines and also some of our productivity for manufacturing. People need these big shells of space to do that, whether they're making, I don't know, airplane doors or the styrofoam that goes in between your car door or little metal pieces for rifles. There's so many manufacturing places out there that need these types of spaces. So we're basically what we're doing is industrial triple net leases, which means that they take care of the taxes, insurance, and the upkeep, which is great as a landlord, especially for me, Tim, because you know how I don't like to get my hands dirty. We'll do say a 10 or 20-year lease with them on agreed upon rent bumps of say 2 to 3% per year, sometimes indexed to inflation. And it's just a really cool asset class. And I really think that we're ahead of the game. We're still buying right now at like between 6 and 8 caps. And we're positively levered on those, which is a nice change from being negatively levered on some of our earlier value add deals. Those are the three asset classes. We're really not trying to have shiny object syndrome. There's a lot of noise in the space right now about build to rent communities. And while I see value in that, I'm just not willing at this point to be a pioneer. I like the fact that multifamily's been around for eons. I like the fact that self-storage is a established asset class, as is industrial. So that's where we're staying for right now.
Yeah, and that all makes a lot of sense. I think the overall point to take away for listeners is that there are a ton of assets out there when it comes to commercial real estate. Despite so many folks using that word CRE or commercial real estate just so generically, there are a ton of asset classes underneath that. I would argue the darling is still multifamily, but there's a lot of other great asset classes. You brought up some great points when it comes to self-storage. They've been saying for a while now that we're going into a recession, so pardon my skepticism. And then, like you said, we're a consumer-based society. People don't like getting rid of their stuff. And if they do need to cut back, which may in fact happen, it's usually, okay, I'll go out to dinner one less night a week, or maybe I won't buy that thing from Amazon. It's very rarely, like you said, liquidating grandma's stuff from the storage space because one, that's a lot of work. That's a lot of work they have to do, and they'd probably rather pay that $50, $100 a month and just forget about it rather than do the work required to get rid of all that stuff. So some really good points there, but we're coming up against the clock. So we are going to transition to the turbo round. All right. I'm going to ask you 3 questions that I ask every guest that I have on the show, and I just ask you for some quick, honest answers. So the first one, what is one red flag every investor should look out for?
When an operator is raising money and they say there's only 3 spots left, and they send incessant emails that you only have 3 hours left to invest or something like that. To me, that's a sign of desperation. If you want to say that you're filling up quickly, that's fine, if that's in fact the truth. But when they're putting pressure on you to invest, and that's a sign that, I don't know, that I would stay away from.
Yeah, that artificial urgency. All right. What is a myth about this business that you would like to set straight?
That passive investing is all sunshine and butterflies, right? I think the term passive investing or passive income gets thrown around quite a lot on YouTube or social media. But listen, there's a risk out there, right? And you got to do your homework. You got to be educated. You got to ask questions. It's not always easy, right? There's deals that I'm a part of as a limited partner that are not paying distributions right now. It is what it is. Interest rate environment changed on a dime, and we just have to build balance sheets, and I'm okay with that, but I understand it. So it's not all sunshine and butterflies, so just do your homework, get educated, ask a ton of questions, and align yourself with the right operators.
Yeah, I couldn't agree more. Not everything is going to go to plan, but I think the measure of a good operator is how they adjust to that. And you just better make sure that they're communicating with you, right? If bad news does not get better with time, as we all know. All right, final question. What does success look like to you?
Success to me is being able to do what I want to do, when I want to do it, with whom I want to do it with, and live life on my terms. And that's what I'm working towards.
Awesome. Yeah, I couldn't agree more. Hey, Tim, this has been awesome. I really like all the insights that you brought and the little different perspective, right, with your position. Please tell our listeners how they can get a hold of you and if there's anything else that you'd like to share with them.
Cool. Yeah, you can just head over to our website, that's my email address, tim@citysidecap.com. But our website is citysidecap.com. I'm on all the socials, and you could also check out our podcast called the Passive Income Brothers Podcast, anywhere that you can get podcasts. And I'm always open for a phone call. I'm always open for an email exchange, even if you don't want to work with us and you just want a second opinion about something. Because really, it's all about relationships in this business. And I think everything, if you have a abundance mindset, everything comes back to you, Tim, right?
Yeah, couldn't agree more. Again, hey, Tim, we'll have all that information in the show notes for our listeners. Thanks again for coming on, and I look forward to continuing to see you do big things on your journey to multifamily millions.
Love it. Thank you so much.